morning. You're watching Businessworld Live. I'm Danie Laurel. Happy Monday. It's the start of a new trading week. Let's kick off with our top story. Finance Chief Sec Dominguez is warning lawmakers that the proposed super rich tax could deter investments and just lead to aggressive tax avoidance schemes. Now, in a letter sent to House Speaker Lord Alan Velasco, Secretary Dominguez said that House Bill 10253, or the proposed Super Rich Tax Act of 2021, is unlikely to boost government revenues in the long haul. Some congressmen estimate that the government could rake in up to 236.7 billion pesos a year from just 50 of the country's richest. However, the DOF said that if passed into law, the bill would generate about 57.6 billion pesos in revenues each year. Under the bill, individuals with taxable assets of more than 1 billion pesos should pay a 1% tax, while a tax of 2% is imposed on taxable assets of over 2 billion pesos, and it's 3% for more than 3 billion pesos. Proceeds of the proposed tax are sought to be used for medical assistance, housing for the poor, and education, among others. Dominguez cautioned that the proposed measure would cause lost investments and reduce new jobs in the long term. He explains that businesses may be discouraged from taking on riskier ventures as they will be subject to tax liabilities on the high capital value of their assets while they generate low profits at the start of their operations. Now, the Bangko Sentral says next year's elections are unlikely to cause consumer prices to spiral out of control. BSP Deputy Governor Francisco Daquila said inflation is seen returning to within the target range in 2022. He sees this happening as early as this month, barring unforeseen shocks coming from the global oil prices. The official added that election spending will not be significant enough to affect the path of consumer prices. The lender's confidence comes despite the warning of the IMF that elevated consumer prices could hang around longer in some countries. Daquila says inflation could even decelerate below the midpoint of the BSP's 2 to 4% target in the first quarter of 2022 on the back of negative base effects and a moderation in global prices. Welcome to a new trading week, but it might not be as exciting as the last couple of weeks. Analysts are seeing the index to move sideways. I'm going to pull out the index for you. And we do see that happening down by 0.2% to 7266.55 already after, we slid 102 points just last week. I'm going to pull out the 1 month chart for you so you can see, that rally that we had above 7,400 and paring back and nowadays moving sideways. Now, RCBC's chief economist Mike Ricafort says that all of this pullback was basically due to the offshore issues. Now, there are rising COVID-19 cases in Europe. Some are record highs here. And of course, you've got protests against those virus curbs, particularly in Germany and Austria. Austria on Friday was the first country in Europe to mandate vaccinations for all adults. That's going to come into effect on February, but there's been a lot of protests on the streets. Another issue that Mike Ricafort has flagged is higher inflation, which could become stickier in some parts of the world, and supply chain disruptions could continue. And the IMF did mention that, and that could become anchoring the inflation de-anchoring rather the inflation expectations here. Another thing to watch out for is whether there will be even more easing of the restrictions here in the Philippines or even in the capital. This according to head of sales of Regina Cap, Luis Limlingan. Of course, there has been a possibility raised by Dr. Guido David of the Octa saying that we might be ready for alert level 1 here in the NCR, basically because we've seen a 27% drop in the weekly average of new COVID cases and a low reproduction rate, so possibly in time for the holidays. Let's take a quick peek at the movers of this morning. You see LTG Group up by 4.7%, followed by Converge and JG Summit. But on the downside, you've got Aboitiz Equity down by 1.6% together with BPI and Meralco. And just one specific stock to watch out for today, you've got Mega World after they have said that they're planning a 6 billion peso business district in Bulacan. That's going to be called the Northwind Main Street. That's going to be within the 85-hectare Northwind Global City Township in Bulacan. There's going to be 145 spots for shopping, commercial lots, and that will be due for turnover in 2026. So Mega World trading flat this morning, trading at 3 pesos and 30 centavos per share. Now, here to chat with us about the prospects as well as the risks, we have with us Paul Angelo, fund manager of the Philippine Business Bank Trust and Investment Center. Good morning, Paul, and welcome back.
Yeah, good morning. Finally, good to be back.
Paul, I just want to kick off with the cyclical stocks here, if you could call them that, and whether we should be picking that up. There was, of course, a lot of excitement leading up to the reopening of Alert Level 2 and the cases that we've seen going down. But as it happens, it seems that the bourse has had a strong resistance level that we weren't able to break back through the 7,400 levels. But tell us, is the rally still ongoing when it comes to the malls, retail, when it comes to the food, travel stocks?
Okay. I guess let's break it down one by one per sector, no? So first, in the property sector, you have the offices. Right now, it's already alert level 2, and as you've mentioned, I think we're already ready for alert level 1. So that means some offices will already require the employees to go back into their offices. So I guess that's already one factor which could begin the ramp up of economic activity, at least in the Metro Manila area, because once these office people go back to the offices, the small stores located near those offices will again begin selling items that they be needing. So yeah, market activity. I mean, it has been, we've always seen it already that this will happen, but it's a good thing that we're really seeing it right now. Now, going to the malls, we've been to the malls recently. You see a lot of them, a lot of people are already in the malls. I mean, even though it is encouraged in terms of economic activity, our health department is actually warning our parents to please do not include the children because it's still, even though we could already go around, still the virus still apparent. So we still need to exercise caution, and I think the people are kind of forgetting that already because they're really eager to go out already. So I guess that's it.
Can we talk about
Travels.
the property sector
Sorry.
first before we move on? Here in the terminal, you can see the year to date is still down 10% for the property players. And this, of course, after quite a low base year in 2020. Why aren't we seeing the recovery, even just, not necessarily to the growth pre pandemic, but at least recovering from 2020?
Well, I guess because the figure that we're seeing right now is just as of 9 months of 2020, and we really haven't seen the activity yet during those times. But come fourth quarter, it will reflect accordingly. But then again, it will already be pulled down by the first 3 quarters already. So I'm pegging that, but we will see the effects of the recovery come 2022 already. So right
Okay.
now it's okay. It's okay for me to see your investments on the red. But if it were me, it's time for you to enter right now, especially
Okay.
on the REITs because this would give you more upside considering that the rates they're giving is actually higher compared to the
Oo nga.
real inflation rate. So you kind of beat it already.
Okay, what about the malls? You mentioned the malls. We had a report from the Retail Association of the Philippines saying that despite the fact that there's been a reopening, the retailers' bottom line hindi pa rin. People aren't spending pa rin. Do you feel that this is the case? People are eating out, like you said, bringing their children, having activities. Pero when it comes to buying items that are discretionary, 'di ba? That are not something that are essential. This hasn't picked up. And how would that affect the retail stocks?
And we're currently at an exogenous shock right now. So I guess these people will have to take their time first. I mean, when you're shopping, you want to buy some items. Of course, you want to have a feel of that item. Some people would want to touch it, give it a feel. But right now, because of the pandemic, you're afraid of touching the items per se.
Okay.
So I guess it's for me, it's gradual recovery. I'm anticipating a gradual recovery. Sooner or later, we these people will go back to normal and spending will naturally come back to normal, especially now it's Christmas season. I think, and once alert level 1 is already implemented, people will have their revenge spending. I'm expecting that to happen already.
What about revenge travel? When you look at the airline stocks, etc. Both Cebu Pacific and PAL have said that they're increasing the amount of flights, but there's so much uncertainty going on still in Europe, in particular, in the rest of the world. Is this the time to be banking on that the fact that the worst is over, or are you still cautious on travel and leisure stocks?
Well, two things. In terms of airlines, we have Cebu Pacific and Philippine Airlines. Even though they're already reporting volumes to be increasing, I think some of them already reported a 40% increase on a year-on-year basis, which is good. But then again, you have to take note that it's not only about the passenger volume. You also have the different countries having their own set of restrictions. So that plays into account also. And you also have the consumer psychology that they're afraid that baka if they cancel, if they book their flight right now, it might be canceled because of the restriction. So somehow there's still a psychological barrier between that. But once it's overcome, by 20 again by 2020, maybe not 20, early half of 2022, probably in the latter half of 2022 to early 2023, I'm seeing airlines could be recovering, not yet on pre-pandemic levels, but at least 80% of pre-pandemic levels.
What catalysts are you still watching out for here? Because if we're already in alert level 2, it's reopened, the cases are very low, 27% drop in cases according to Okta. Why are we not going above the 7,400 levels again? What's it going to take, and what are you looking out for in the fourth quarter that might spur a continued rally?
Right now, I'm already looking at election season. As you've seen, if you're going to monitor stock market movements during a non-election season and an election season, it's always favoring on the upside, favoring the election season. Like for example, for a non-election season, you have 4.4% growth. In an election season, it's 5.3. So I guess that's it. Not only about the stock market movements, capital movements is also apparent. Lots of borrowings, lots of rallies, lots of support. And from there, we could see a lively first half of 2022. But then again, I'm worried about inflation.
Okay.
Because although there is a pronouncement by the PSP that election activities may not have an effect on inflation because of some tapers available on account of restrictions, it's not. It's still worrying because the defense of transitory of the inflation being transitory in nature is okay, but the problem is how long will it be transitory? So
Okay.
I guess that's it.
Okay, what about the fact that in election period there might be some instability when it comes to policy and even the response to COVID and how that affects the foreign fund inflows? Can you relate that with the movement of the foreign funds and an election year? You mentioned that it's always positive, but is that the case even for our foreigners coming back in?
Well, the only thing about that is that even though some foreign funds are cautious in entering, not only in the Philippines, in any particular market wherein there will be an election season, but the thing is, they should never go out of the country just because of the political risk. They have to be present in us because if uh, who knows, maybe we could have a positive political sentiment. They were not able to ride it. So I'm not worried about foreign funds staying out. I'm more worried about um foreign funds remaining to be inside than rather those foreign funds beginning to come back in.
Okay, very interesting point there. What would bring them back in actually? Because we still see, we need to look at the figures, but it does seem to be the case on the chart that it's still net foreign selling. And this despite the fact that we've in the past couple of weeks we're best performer in Asia. Why aren't they still coming into emerging markets now?
Well, it's basically not because of the risk associated with the emerging markets, but basically because the foreigners are also weighing their stances because in their own countries they're also facing challenges and risks. Right now, in Europe and US, they're already having increased number of cases, especially in Europe. So from there, they have to recalibrate their portfolios first. They have to make sure that their positions in their own country is safe first before they go out of their portfolio, before they go out of a different country's portfolio.
Okay, so it's about balancing the risks here. I just wanted to ask on a specific stock. A lot are looking forward to the opening of IKEA, which is set to be the largest branch in the world or biggest outlet in the world. How would this be received when it comes to the retail sector booming in the coming months? Despite, of course, the fact that unemployment is low, people have holes in their pockets, and this vis-a-vis the existing retailers in the home space, All Home and Wilcon.
Okay. As to IKEA, I think the two existing firms, All Home and Wilcon, already made their statements that they're not worried about the entry of IKEA. As a matter of fact, they're welcoming the entry of IKEA because I think they're categorizing IKEA into a different metric as compared to them. But other than that, there's always a hype following an opening of a foreign brand here in the Philippines. Give it time. Naturally, these two locals might lose some shares, some market share, because all of them will go to the new one. But sooner or later, people will realize that maybe there are some items that are better in terms of pricing on the local side. So the hype will die down eventually. Give it a couple of years, a couple of quarters, or a couple of years. A perfect example, I guess, would be Food Pan. Sorry, not Food Panda, Panda Express. So if you take into at first, a lot of people were falling in line when Panda Express opened up, but then they realized maybe the food portions is not that big enough, or the pricing, I don't know, or whatnot. You'll realize that the hype will begin to die down, and naturally, your sales will gradually recover and stabilize. I guess that's it.
Okay, so not a threat to the two incumbent players
Yes.
for the time being. But as you mentioned, you're still quite hopeful in terms of the revenge spending, as you called it, when it comes to retail, especially moving towards the election season and 2022. Thank you so much for those insights, Paul Angelo of PBB Trust.
Thank you.
Here are the headlines we're keeping our eyes on. Fitch Ratings says rising public debt could lead to a credit rating downgrade for the Philippines. The credit rater explained that it would consider the country's public debt to GDP ratio in the medium term, especially as finances in the Asia Pacific improve. Rating downgrades could occur not just for the Philippines, but also for India and Japan, which are on a negative outlook. Recall that the rating company changed its outlook for the Philippines from stable to negative amid increased risks to the country's credit rating profile during the pandemic. The country's debt to GDP ratio was at 63.1% in September. That's the highest in 16 years. Now, passenger traffic at seaports grew by more than 1.5 million in the third quarter. Data from the Philippine Ports Authority show that from almost 3 million in the third quarter of 2020, passenger traffic rose about 52% year on year. However, this is still below the 17.3 million recorded on the same period of last year, which indicates a slow recovery for the industry. Chelsea Logistics says the third round of community quarantines in NCR and other major cities in August significantly affected their passenger business. But starting November 4th, the government already increased the allowable carrying capacity of passenger ships to 70%, while more destinations have also relaxed restrictions and are now accepting tourists. With this, the To Go Group sees gradual pickups in passenger bookings. The company announced that 90% of its network destinations are now accepting leisure visitors. And that's a first look into the business day. Today is Monday, November 22nd, 2021. Catch Business World Live for the market closes at 3:15 p.m. today. I'm Danie Laurel. Mask on, wash hands, stay safe, Philippines. We are winning.